Here's what most people miss about six-figure tax debt. It's almost never one bad decision. It's compounding decisions. It's probably best if I give you kind of a case scenario. Let's take a self-employed consultant. Maybe they had a strong year, a couple $100,000 in revenue, no employer withholding, no estimated taxes going in, and then the tax bill comes in. Year one, the bill lands and it's painful, so the return really doesn't get filed. Then year two stacks on top of that. Now there's a failure to file penalty, which are steep ones. The failure to pay penalties and the interest running on them all the time, including all the other penalties. So now let's give that 3 or 4 years. That balance can roughly double a couple of years, right? So if you're thinking the tax is 20 grand, make 40 grand. The number on the notice stops looking like anything you can ever remember earning. And if some of those years are substitute for returns, those are returns where the IRS filed for you with zero deductions, zero business expenses, then part of that balance isn't even really making any sense. It's just a placeholder the system created because you were quiet. Here's where people get this whole thing wrong. They treat the whole thing as fixed and they start panicking about how to pay it. First question you need to ask is never, how do I pay this? The first question is that number even right? Frequently, when people come into my office, it isn't. Now let's talk about the centerpiece of every large balance case is financial disclosure. The IRS doesn't take your word for what you say you can pay. They want what's called the Collection Information Statement, Form 433, in its various flavors. And it is thorough, let me tell you, okay? So it takes a look at your income, every account, every asset, every vehicle, your household expenses, line by line. Now for business owners, the business version is a little tricky. You have to back that up with financial statements and documentation. And this is where a large case is either won or lost. Not in some dramatic negotiation with like some Perry Mason situation. It's all here on paper or computer screen. Because here's what that form actually does. It computes what the IRS calls your RCP, your reasonable collection potential. Their math for what they believe they can get from you. Now, every resolution at this level flows from that calculation. Math, remember? I said it's all math. So you fill it out too optimistically, and now you've committed to payments that you can't sustain through the whole agreement. That agreement defaults. So if you fill it out carelessly, you've got overstated what you pay, costing yourself real money every month, or you've underestimated something and it's verifiable, and they're going to catch that. And that costs you the whole thing. You could at least afford to deal with a revenue officer, want to be credible. And this is where the IRS stops paying attention to you and more to the details. They can see payroll records. They can see 1099s filed underneath your social security number, your bank deposits. At this balance level, assume everything checkable gets checked by the IRS. And so they have to be defensive. So let's reset your mind. Let's clear out all the noise you get on the internet. Because if you owe a big number, and you've heard it on the radio ads, settle for less with the IRS. Settle your tax debt for almost nothing. Do the fresh start. It's for a limited time. Here's the honest story. This is a real settlement program. It is there. It's called the Offer and Compromise. It exists. It works. When someone qualifies, which is rare, it can genuinely resolve a large balance for less than what the IRS says you owe. But the qualification is a formula, not a sales pitch. And it's not built for everybody. It's built for the same financial disclosure, exactly the same things, plus what your income can produce over time. If the formula says that the IRS can collect more than you're offering, your offer fails, no matter who you hired or how much you paid or what the ad promised. So what's the actual manual at large balances? Well, installment agreements, including ones where, with the right financial showing, the monthly payment is actually based on what you can afford. So think of this as just like an offer and compromise, but rather than what you fully owe, you pay what you can afford. Currently not collectible is where collection pauses, because the math shows that there's really nothing they can afford to collect from you right now. But the offer and compromise, when the formula supports it, is pretty good. Now, penalty abatement can take a real bite out of the snowball, but sometimes there's relief for a clean compliance or for genuine circumstances beyond non-compliance. Quietly, underneath all of it, is a clock that keeps on ticking. Which brings me to the thing that the ads never really mention. You see, every IRS collection case has a clock running underneath it. By law, thanks to Congress, the IRS generally has 10 years to collect the tax, and that's 10 years from the due date of the return or the date the return was filed. It's called the CSED, the Collection Statute Expiration Date. And when it expires, what's left of the balance goes away. Now, you need to be careful with this. And this is not let's wait them out advice. The IRS knows their deadlines way better than anyone, because they've got computers programmed for it, and accounts tend to get more attention as their clock runs down. And some things you can do, like certain filings, certain requests, those are the kinds of things that pause the clock and extend the timeline. One of those is applying for an offer and compromise. Now, sometimes that trade is worth it, but sometimes it's a costly mistake. But here's why that matters for a large balance. Your strategy at this level is played against that clock. How many years are left on each assessed year? Which resolution path preserves the timeline, and which one resets the whole chessboard? Gotta be careful, because two people with identical balances can have completely different answers, because their clocks sit at different places. This is exactly the kind of thing you cannot see from the outside. All of this information lives in your IRS transcripts. And reading those transcripts correctly is step one of any serious plan. Now, let me tell you who needs to hear this one. Let's say you owe the IRS a number, you stop saying out loud. That's pretty big. Maybe it's spread out across several years. Some of those years are unfiled. So realistically, you don't even know the real total. Letters are coming, you're still functioning. There's a low hum of all of this in the background of everything, and it can get to you. Every deposit that hits your business bank account, every plan you move this 1 year further out. That's an honest mistake, but real honest effort is at this balance level. That drift has a price. Liens that complicate selling, levy exposure on accounts and receivables. Now, there's this passport process if you're over that threshold. And every month of penalties and interest, quietly raising the floor. Now, none of that is the IRS being cruel. It's a system doing what it was built to do. Now, nobody on your side of the table is doing anything. So the decision moment is this. Every path I described earlier, every one of them, the affordable installment agreement, the hardship status, the offer and compromise, the penalty relief, the clock strategy, every one of them works way better, more options on the table, and options close as enforcement advances. The best cases are the ones where the person engaged while it was still just letters. The hardest ones waited for the levy. So here's the plan, in plain order. Step one, get the real picture. Find out, get transcripts for every year. From that, you're gonna find out what's assessed, what's penalties versus tax, not like split them, but where each year's collection clock stands, which years are substitute for returns. You cannot strategize against the number you haven't verified. Number two, fix the number. File any unfiled years with accurate, defensible returns, including your expenses. Replace the placeholder return with reality. In large cases, this step alone can change the entire shape of the problem. Step three, match the resolution to the math. Not the ad you hear on the radio or TV, and not to fear, to your actual financial statement and to your actual financial timeline. I'm Josh Webskowski. I'm an enrolled agent. I'm admitted to practice before the United States Tax Court, and I'm an NTPI Fellow. Large balance work is what I call reconstruction and defense. What we want to do is rebuild the records, making every number on your financial statement hold up on its own, with support to withstand an army, and putting you on the resolution path the math actually supports. If you're carrying a balance like this, book a case evaluation. Let's face it, we can pull the transcripts and understand them, find the real number, and then map out your options, each and every one of them, with the trade-offs, and explain them to you in plain English. You'll leave knowing exactly where you stand. That alone changes how this feels. Big time.